Listen, I need you to stop what you're doing right now and pay very close attention to what I'm about to tell you, because what is happening in these markets tonight is not a coincidence. It is not a correction. It is not profit-taking. What is happening right now is the most perfectly engineered institutional setup I have seen in the last 3 years. And if you don't understand what I'm about to show you, you are going to wake up Monday morning wondering how you missed the most obvious signal that Wall Street has ever put in front of retail investors. We have exactly 48 hours. 48 hours. 2 days. 172,800 seconds from the moment you're watching this video. And when that clock hits zero, the financial landscape that you are looking at right now is going to look completely unrecognizable. Because the same institutions that spent today smashing silver down, the same hedge funds that triggered every stop loss between $88 and $84, the same algorithmic trading desks that dumped paper contracts into a thin overnight session to shake out every retail holder who bought in over the last 3 weeks, those exact same institutions are about to flip. And they are not going to flip slowly. They are not going to flip gradually. They are going to flip violently, aggressively, and with the kind of capital behind them that moves markets by 10 and 15% in a single session. And while you were watching the price drop today, while you were reading the headlines about silver's pullback, while CNBC was putting their analysts on camera to explain why this was healthy consolidation in a mature bull market, the people managing $100 billion portfolios were doing something completely different. They were running weekend risk calculations. They were looking at their derivative exposure. They were staring at geopolitical timelines and asking themselves one question. One question that every single risk manager on Wall Street is asking tonight. Can I afford to hold these positions into a weekend where everything could change before I can trade again? And the answer they are arriving at right now, tonight, in offices across Manhattan and Chicago and London, is no. They cannot. And that answer is what is going to drive tomorrow's price action in a direction that the mainstream financial media is completely unprepared to explain to you. I'm OG John, and this channel exists because the truth about these markets is never going to come from the people who profit from keeping you uninformed. Before we go any further, nothing I say here is financial advice. This is pattern recognition. This is institutional behavior analysis. This is 50 years of market history laid on top of what is happening right now, so that you can see exactly what this setup actually is and make your own decisions from a position of knowledge instead of fear. Now, let me explain exactly what happened today, because this is where it gets important. Silver dropped hard. The paper market got absolutely worked. And the narrative that got pushed into every financial feed, every trading alert, every mainstream commentary was the same narrative they always use when this happens. Profit-taking, healthy correction. The bull market needed to breathe. And retail investors, the ones who bought at $91, the ones who were holding with conviction, they looked at that drop and they felt the doubt creeping in. That is not an accident. That doubt is the product. That doubt is the entire point of what happened today. Because when retail sells into that fear, someone is on the other side of that trade, buying everything they can get their hands on before tomorrow's session opens. This is the liquidity grab. This is how it has always worked. You cannot manage a $15 billion fund and just walk into the market and start accumulating at full price. Because the moment you start buying size, the price moves against you. So what do? You engineer a drop first. You use the paper futures market, the COMEX overnight session where volume is thin and there are no physical buyers large enough to absorb the pressure. You dump synthetic short contracts into that vacuum, and you watch the technical traders get stopped out. Watch the momentum players flip short. Watch the retail holders panic sell into the move. And then you quietly accumulate everything they're selling at a $5 discount before the real catalyst arrives, and the price goes to levels that make today's entry look like the trade of the decade. This is not theory. This is the exact playbook they ran in March 2020 when they crashed gold down to $1,400 right before it rallied to $2,075. This is what they did to silver in 2011 when they smashed it from $49 down to $26 and wiped out an entire generation of retail bulls before the next cycle began. They do this every single time there is a major catalyst on the horizon because they need the inventory. And they need it cheap. And the only way to get it cheap is to make you believe it is going lower before it goes dramatically higher. So let me tell you exactly what happens tomorrow and why the timing on this is so precise it almost looks scripted. Because in a way, it is. Friday is the last trading day of the week. That's not unusual. What is unusual is the specific geopolitical and macroeconomic pressure that is sitting on top of this particular Friday like a loaded gun. Every institutional risk model on Wall Street is currently flagging the same variables at the same time. Dollar weakness accelerating. Treasury yields under pressure. Physical silver premiums at dealers quietly rising even as the paper price gets smashed. Central bank gold buying that has not slowed down for 3 consecutive years, and a geopolitical backdrop that has not been this combustible since the early days of the Ukraine conflict. When you stack all of those variables together, and you look at them from the perspective of someone managing leveraged positions that they cannot adjust after 4 o'clock this afternoon, the calculus becomes very simple. You either reposition today, or you accept the possibility that Sunday night's futures open looks nothing like Friday's close, and there is absolutely nothing you can do about it. That is the mechanism. That is the forcing function that is going to drive aggressive institutional buying into precious metals tomorrow from the opening bell through the close. And it is not going to be subtle. You are going to see it in the volume. You are going to see it in the way the price holds higher lows on every minor dip. You are going to see it in the gold-silver ratio compressing as silver outperforms. And you are going to see it in crude oil if that starts to move. Because a crude oil rally tomorrow confirms that the geopolitical risk premium is finally getting priced across the entire commodity complex simultaneously. Now, I want to give you the bigger picture, because this is not just about one Friday session. What we are watching right now in real time is the early stage of a structural reallocation out of dollar-denominated financial assets and into hard physical assets. The dollar index has been in a grinding decline for over 2 years. The national debt has crossed $36 trillion and is accelerating. The interest payment on that debt alone is now over $1 trillion annually. We are borrowing money to pay the interest on money we already borrowed. That is not a sustainable trajectory. That is a debt spiral. And the rest of the world is watching it happen in real time. The BRICS nations are not buying gold because they like gold. They're buying gold because they're positioning for a world where the dollar no longer functions as the unchallenged global reserve currency. Central banks globally purchased over 1,000 tons of gold in 2023, over 1,000 tons again in 2024. These are the institutions with the best geopolitical intelligence on the planet, and they are all moving in exactly the same direction. When the smartest money in the world is this unanimous about an asset, you do not need a 48-hour deadline to tell you which way this is going. The deadline just tells you when the acceleration begins. I've been building my physical position for months. I slept fine last night, and I will sleep fine tonight. Not because I'm ignoring the risk, but because I positioned for it before it became obvious. That is the only difference between the people who end up holding at 86 and the people who end up panic buying at 115, wondering how they missed it. Make sure you are subscribed to OG John XX with the bell notification on, because I am recording an emergency update the moment the Friday close prints. That video is going to show you exactly how much institutional capital rotated into this sector today, what the technical setup looks like heading into the weekend, and what I expect when the futures market reopens Sunday evening. 48 hours from now, This either moves the way the setup says it moves, or it doesn't. Watch the price. Watch the volume. Watch what happens when institutions who cannot afford to be wrong have to make their decision in a single session with the clock running. And then ask yourself whether you were on the right side of that move, or whether you were still listening to the same people who have been wrong about every major crisis for the last 20 years. The clock is running. Position accordingly.